welcome. Thank you very much for joining this webinar. I'm super excited about this. This is definitely one of my favorite webinars of having done way too many webinars over the past couple of years, but I love doing these webinars with Mark, and I am especially excited about tonight because there's just so much going on in the world. So it will be great to get Mark's insights. So Mark is the head of research for Julius Baer Private Wealth Banking. Has been doing this for many years, has very kindly done several webinars with us over the years now, and always provides fantastic insights and unique viewpoints on, or unique collections of data from all around the world that I think you'll find very useful. And I just think there's so much going on right now. It's really useful to have someone that has some context and can try and give us some direction. When the stock markets are crazy, the crypto markets are crazy. We've got supply chain issues. We've got the Great Resignation. Here at MBH, we're seeing huge demand from the clients of our small businesses, but we're also seeing more sick days than we've ever seen before with Omicron. So lots and lots of stuff going on, and very excited to have Mark with us. So Mark's going to present for about 30 minutes, and then we'll have Q&A. So if you have questions, type them into the box. I'll try and get through them at the end of the session. And with that, Mark, great to see you again, and I'll hand over to you.
Thanks, Callum. And I love doing these too, by the way. And I just hope that people aren't too disappointed by the end of it, because number one, I just have a bunch of slides. Number two, they'll probably end up even more confused at the end because I'm confused myself. But you just talked about actually some of the really key issues in my mind. When you mentioned you've got a lot of people on sick leave due to Omicron, I think you probably mentioned one of the most salient issues. So I'll get into that during the course of the presentation. But I'll briefly go through these four columns that represent our current thinking. And on the left, you can see the big picture. That's the macroeconomic outlook. And I highlighted in red something that I'm going to be spending, frankly, most of the presentation talking about. The loss of central bank guidance and policy errors are the biggest risk for financial markets. So it is the million-dollar question: how hawkish are they going to be? And currently, our stance is that they won't tighten as much and as fast as the street is saying. When I mean the street, I mean, for example, Bank of America last week put out a report saying the Fed's going to have to raise rates 5 or 6 times this year. Jamie Dimon said, I think something like 6 or 7, or maybe it was 8 or 9, I don't know. But Credit Suisse were saying that the Fed is actually going to actively sell its balance sheet, its treasuries and the secondary market, something they've never done before. So if that kind of thing happens, markets have a heck of a lot more downside. And so the other 3 columns would suddenly have a lot less relevance. But I'm going to assume for the time being that we're right and they won't tighten as much and as fast. And therefore, we would think that basically moderate credit risk, if you look at the second column from the left, has the best risk-reward ratio, the so-called crossover space between investment grade and high yield bonds, where you get, depending on the geography, 3% in the US or 3 to 4%, but out here in Asia, you can get 5 or 6% in countries like India and Indonesia. In dollars. If we're wrong and the Fed does tighten a lot, then flexible strategies where the fund manager can immediately go long duration treasuries, et cetera, would be better. And so it's prudent to own probably a mix of those in fixed income. And in equities, every single crisis, some companies will come out stronger. And the trick is to identify which. They're nimble, they stay ahead of the curve. And in this day and age, that means embracing digitalization. So I'm not talking necessarily that it has to be a technology company, but it has to be a company that has a very strong brand and very good cost control, and embraces digitalization. So to prove my point about companies that aren't necessarily technology companies but are coming out stronger, L'Oreal would be an example. So you probably all know L'Oreal is a beauty products company, and I won't go into the details, but we have a list of about 12 companies like that we observe have actually increased their market share, increased their margins, expanded dramatically in the digital space, and that is the post-pandemic companies that one would want to own. And it takes me into the fourth and final column, which is that cloud computing and artificial intelligence, I think unbeknownst to most people, have been part of our lives really for the last 20 plus years. But really, they're becoming so mainstream now that they still provide a lot of growth opportunities. And the companies that are number one in that space are the FANGs. Amazon and Microsoft, somebody correct me if I'm wrong, I think are the number one and two largest cloud service providers, and artificial intelligence is, obviously those companies, but Google, Facebook, watching what we're doing and making money off of that. And that is going to continue to be the case. But I really want to focus on monetary policy, is what I said. And the big news yesterday was the Federal Reserve's January meeting. I must confess, I, for one, was surprised. I thought they would walk back the hawkishness, and frankly, they didn't. So they said they're ready to raise rates in March. There's no real shock about that. But they didn't try to tone down the market's pricing in of a faster rate hike cycle. And in fact, Jerome Powell said that since their last meeting in December, he'd become less confident in his projection of how far inflation would decline. And that does, quote unquote, raise the risk that it will be more persistent and the Fed will have to raise rates more aggressively. And on the quantitative tightening, which means shrinking their balance sheet, which they first said they would do in the December minutes, which were released on January 5th. So I think it's no surprise or coincidence that the S&P peaked on January 3rd, because those minutes were the shocker. Nobody really anticipated, and I'll talk about this, the Fed shrinking its balance sheet so fast. But he did say that they would do it. He reiterated they're going to do it once they've started raising rates. And there was really no guidance about exactly when they would start. But basically, they did still stick to the idea they're going to significantly reduce their $8.8 trillion balance sheet. And I'll show you why that's important later. So I think that the appetite for a more aggressive pace of tightening that many people had hoped for, it simply didn't happen. And they have not been cowed by the turbulence in the market over the last week. And so the Fed Fund Futures, which is basically the futures market, has a Fed Funds product, which you can invest in, and you can make a bet on where you think the Fed's prime rate, in other words, the Federal Reserve fund rate, the money that it lends overnight to commercial banks and they lend to each other, will be by the end of this year. And this chart shows how many rate hikes the market expects by the end of the year. So if we start over in June, the market was looking for, it looks like about 0.75 rate hikes in by the end of 2022. And now you can see it shot up to 4.6 rate hikes this year. Now, just 2 weeks ago, they were guiding for around 3. So that's quite a big change. And they're clear in their minds they want to raise rates at the Fed. And I think they're right to do so, because by some definitions, the economy, in fact, is too good. For example, we see here what's happening in the labor market. The Kansas City Fed uses 24 variables to create a composite of labor market activity. That's the black line. And labor market activity is as high as it's been since the year 2000. Then the blue line is the Fed funds rate that I just told you about. And you can see in the past, it's moved in tandem with the labor market, but this time, the black line's way at the top and the blue line's way at the bottom. And it's this chart and charts like this that have led economists to say the Fed is way out of whack, way behind the curve, as Bank of America wrote last week, quote unquote, hysterically behind the curve. So why is the labor market so tight? A lot of it has to do with COVID. First, there's immigrants. And because of COVID and the travel restrictions that we still face to this day, there have been really no immigrants to the United States in the last 2 years. Actually, there are 2 million fewer working age immigrants than there would have been if the trend before COVID had continued. Then there's the baby boomers. They're feeling braver about retirement. Now the values of their homes and their pension funds are much higher than they were a couple of years ago. So we see here about 3 million of them have left the workforce. And frankly, I don't expect most of them to come back. Some will come back because they're older folks. So some of them probably didn't want to go in the office while COVID was going on. If COVID becomes endemic, I'm going to talk about that in a second. I think some will come back, but it'd be good if not all of the older folks came back, because that means some of the younger people can get jobs. And a lot of the younger people have really thrown in the towel. They're not even bothering trying anymore to be successful, in a material kind of way in life. And a lot of them have joined this so-called anti-work movement, whose motto is unemployment for all, not just the rich. I love that. And they're basically saying people should work the bare minimum or not at all, and just enjoy their lives. It's a form of rebellion like China's lie flat movement. But I think the origin of it is when something as simple as owning the roof over your own head is impossible, then why are you even going to try? And so I'm sympathetic to them because COVID has also caused in part a very large rise in house prices, which we see at the top right of this chart. House prices up about 20% year on year, double what they were 10 years ago. And the young people know that one of the reasons for that is that rates are very low. And so the older people who do have good jobs can get mortgages, and then companies like BlackRock, other big private equity companies can borrow cheaply, and real estate trusts can do the same thing and go out and buy all sorts of residential real estate, which they're doing, and then turn around and rent it out for a great yield. So what's happened is the inventory of housing is a quarter what it was in 2015. And if you look very closely at a little bit to the left of the middle, 2018, 2019, inventory was actually starting to rebalance. Why? Because that was the time the Fed was tightening. They were raising rates, they were shrinking their balance sheet. What happened after that was the pandemic started, and so you can see the inventories just collapsed after that. And but work at home would have been another big thing behind that. People wanted to buy nicer places to live in, and the low interest rates that I told you about, et cetera, et cetera. And then another reason too with COVID, and so I was interested when Callum was talking about his staff who are on sick leave, is that builders have a scarcity of tradespeople. COVID isn't killing as many people before, but it's making a lot more people sick. So they're staying at home. In fact, the Census Bureau found that from the 29th of December to the 10th of January, more than 14 million Americans at some point didn't work because they either had Omicron or were carrying somebody who had Omicron, or they had to look after their child because the school was closed. And another 3.2 million stopped working because they were concerned about getting or spreading COVID. And so another factor behind inflation that we can link back to COVID is a demand factor, because when we look closely at what's driving inflation, there are a lot of things, actually. I just mentioned one was property, and that's a big one. But another big one is goods. And goods means merchandise, products, stuff, basically. Like this is a good, So what happened when COVID hit is that people stayed at home. Each adult in America got a stimulus check. There were 3 of them. The total was $3,800. And there was lots more stimulus apart from that. They couldn't go out to restaurants. They couldn't travel. So the services, the brown line collapsed. And what they did was they bought a ton of goods. That's the blue line. They just bought a whole bunch of stuff online. And the economy simply wasn't prepared for that kind of demand. And at the same time, capacity was cut back. For example, in the car industry completely misread COVID. no fault of their own, because we hadn't had a pandemic since the Spanish flu, but they thought nobody's going to buy any cars. So they slashed investments, they slashed their orders for components and chips. That's why the dealerships are empty. And that's why the price of used cars has done this. But the question is this line going to keep going up forever? And the answer is it's unlikely, because it's not like we had a war or an earthquake or something that destroyed the capacity. The capacity is all there, and it can be brought back if COVID goes away. At the same time, people aren't going to be permanently staying at home buying more stuff with stimulus checks either. In fact, you see here that savings as a percent of disposable income went from 5% to over 30%. And now they're back to where they were. So if we're right, and I admit it's a big if, but if we're right that Omicron spells the end of the pandemic, countries go back to the way they were before, which is what the Europeans are doing. We see if others follow, then capacity comes back and transportation normalizes and more people join the workforce and more people buy services and therefore less goods. And then the price of goods should fall. And then these bottlenecks should start to ease as well. The bottlenecks, a lot of them are contributing as well to the big rises in durable good prices. So durable goods are things like, kitchen appliances and furniture and cars. And that's about where a third of the inflation is coming from. So you can see that the stress in the supply chain is still a big problem, and the reason is COVID. And so what Janet Yellen thinks, and I tend to concur, and she said it was critical. She said this last week, for more people to come back into the labor force, because that'll help to ease those supply pressures. It's not like the ports got destroyed. It's not like the container fleets all sank. It's just that there aren't enough people to man them, to operate them. And that would basically, bring down inflation. But for that to happen, the pandemic has to be brought under control. So will the pandemic be brought under control? Well, we can see that according to a poll of over 100 specialists, different kinds of specialists in over 20 countries, 80% of them do think that it's very likely that COVID is going to become endemic. And to be clear, endemic does not mean it goes away. It's not going to. It's part of our life now. And it's not harmless. People will die from it just like they do the flu. That's just the way viruses are. And the viruses that we know today is the common cold, the flu. They're all less severe than COVID because we've had generation after generation to go through these things, repeated infections, so that everybody's immune system has become primed to fight them, regardless of whether you're getting a flu jab or not. No respiratory virus was ever successfully managed by vaccinations, by the way. At best, flu jabs have a 50% success rate at stopping you from getting the flu, because it's mutating every year too. But what they do have a good track record of doing is preventing serious illness and death. That is well established. And by the way, I want to say, on a side note, the deaths in the US are now back to where they were above Delta, actually. But you need to take this in context, because bear in mind, these people are dying with COVID. Probably only a fraction are dying of COVID. And what I mean by that is, if you walk in a hospital, the first thing you will do is get a COVID test, even if you go in to get some stitches removed. And if you test positive for COVID, the hospital gets $300 right away. It doesn't matter what you're treated for. If you happen to die in a car accident, and you had COVID, that gets counted as a COVID death. And even Dr. Anthony Fauci said there's a difference between with COVID and from COVID, and they don't have the numbers to show which is which. So they're putting them all together as, COVID, period. And because so many people have COVID now, I mean, I know so many people who do, just as Callum said, that, some people who are dying do happen to have COVID. Anyway, if COVID fades away and the inflation starts to come down later this year, then this is what our forecast is. We're looking for peak basically in the fourth quarter of last year at 7 for the US, which is the blue bars, then to 6 in the first quarter, down to about 4 in the second quarter, down to about 3 in the third quarter, and then about 2.5 by the end of the year. And that's what Janet Yellen said she expected. She's looking for about 2.5 by the end of the year. So if you were in the Fed's shoes, after you raised rates twice, You're going to do it in March. You're going to do it in June. Wouldn't it make sense to wait and see what the impact is? Because it takes a while for the interest rates to have their impact made in the economy. And then you do more if you need to. But by the summer, it might be pretty obvious you don't need to do a third or a fourth or a fifth. Why do them all at once when you can pause a little bit? And that's why I still feel that the Fed and the market are actually both talking about a scenario that is probably on balance less likely than more likely, which takes me over to markets. And the last time the Fed began a rate hike cycle was in December of 2015. I just realized the red line is not where it should be. I'm sorry. The red line should be over in 2015 where the black line bumps up for the first time. And it waited 2 entire years before that and when they started shrinking their balance sheet. And that actually is where the red line's supposed to be, actually. So the balance sheet is the blue line on the bottom. If you look very closely, they started shrinking it at the beginning of 2018. So they waited all through 2016 and 2017 before they started, between the time they first raised rates and they started shrinking the balance sheet. Now they're talking about just a few months between the two. And the thing is that even back then, when they waited 2 entire years, even then the market still didn't like it. If you look at 2018, what I put in red, bond market and the stock market both went down that year, and that's an unusual occurrence. And I admit that was when the trade war was in full swing, but actually the reason why the markets were down wasn't the trade war. That was all noise. The real reason was they didn't like the Fed tightening. They thought the Fed was tightening too much. Now, usually what happens when the stock market goes down is high yield bond yields go up. High yield bonds tend to correlate more closely to equities than treasuries. But this time it hasn't happened, which is kind of interesting. Corporate high yield overnight OAS is basically still options adjusted spread is basically still flat, whereas the S&P's down about 10% from its peak. So high yield seems to think the Fed is not going to raise rates a whole bunch this year, and the stock market seems to think it will. So which one is right and which one is wrong, only time will tell. But just to put what happened in context, we're now down, if you look over on the far right, 9.7% from the peak of the 4th of January. And when you put it in the context of the maximum intra-year drawdowns since 1980, of all the years since 1980, and so those are also the little blue diamonds. So the average of them is 14%. So yes, we've gone down, but that's what stocks do. And this table is ordered from the most recent sell-off to the oldest one. So we're at the top. And so I just said 9.7. There you go at the top right corner from the peak on January 4th. And below us, there are 26 other times since the end of the global financial crisis when the index also went down 5% or more. The last time that it went down as much as it has today was September 2020, 10.6%. I think it's about the 5th one down by the looks of it. Now, to be honest, I don't even remember why the market went down in September 2020. I'm sure there was a reason at the time. Everybody was very worried, but I don't remember it. And I challenge anybody here actually to tell me what was happening. So the basic question is, are we really going to be worried about the same things we're worried about today, 6 months from now? Or will it be like, they'll look back at this 10% decline and they'll say, look, that was a great opportunity to buy. I actually don't know the answer. Is it a big one like the COVID sell-off or the European crisis or the global financial crisis? Or is it just going to be a little one like September 2020 and we don't even remember the reason why? Whichever one it is, I do think it's probably safe to say we've entered a new phase, a new trajectory for the market. You see the big bull market from the end of the global financial crisis. And then COVID just took it to a totally different trajectory. That was a parabola, right? And it is now somewhat broken. So definitely there's a sense that something has changed. Dare I say we're in the post-COVID trajectory. That might be not a good thing to call it. Might be jinxing ourselves, calling us post-COVID too early. But definitely there's a sense that something's changed. And even here in Singapore, where frankly we've been very, very slow to open up, I myself have noticed, and we just clocked 4,800 cases yesterday. Nobody seems to care. I see a lot more people in the office and around Raffles Place than a few weeks ago. A friend of mine who's retired, so he stays at home all day, tells me he notices that during COVID, all the cars were in his parking lot in his condo, and now half of them are gone during the day. So people are going back to the office, and we at Julius Baer did our first live presentation at the Ritz-Carlton Hotel last week, and we had to turn people away. So I feel that life is normalizing, and I know it is elsewhere. For example, as of today in the UK, you don't have to wear a mask anywhere in shops or in public transport. You don't have to show a vaccination certificate anywhere. What comes next, we don't know. But I think it's safe to say we're not going to go back to the bull market we had last year. And that might not be a bad thing, because it was kind of crazy, like this GameStop company, which if you ever have spent any time in North America, you would know this company has no future. They sell video games in stores. And yet it went up 400% at one point last year. So the diamond hands, you know what I mean? The Wall Street Bets Redditors and the Bored Ape Yacht Club, NTF guys, I think that we can safely say that's in the rearview mirror. And it's not exactly the same thing, but here you can see the earnings growth profile for the first time since April 2020. Earnings guidance tracked by Bianco Research has dipped into negative territory. Now, I suspect it's simply because analysts are reacting to falling share prices. Having been an analyst myself, I can tell you that they do that. When they see the markets going down, they start to think, gee, I better adjust my target price. Otherwise, everybody's going to be laughing at me with a target price that's, 100% higher than the current share price. But they can't just do it and write a report saying, I am downgrading the share price target because the stock market's falling. That would look even more stupid. So they have to make an excuse and they have to downgrade their earnings. So I think that's probably more the analysts just following the market. But according to Goldman Sachs, and they're not the consensus, but they are a widely respected bulge bracket firm, the S&P's earnings growth this year, you can see there the difference between 226 and 209, that's about 6%. And then next year, difference between 236 and 226, also about 6%. Very big difference between that and last year's earnings growth, which was a 47% increase. So we can go up, but probably not as much as during the pandemic. And in a way, the Fed signaling that it's going to raise rates is a sign that we are entering the post-pandemic era, because I really don't think they would raise rates if they weren't confident the pandemic is ending. And when you look at the previous rate hike cycles, that can also provide us with some comfort, strangely. We're looking at the MSCI World Index, but the S&P would show us pretty much, for all intents and purposes, the same thing. So in the past 10 rate hike cycles since 1970, and from the date of the first rate hike, 12 months later, 24 months later, only in two of those cycles, the 1971 and then the 1981 and then the 1994 one, were markets down, 1 and 2 years later. The average, including those two down years, was about 6.9%. So I think, we can probably clock around 6.9% this year. We can probably clock a sort of between 5 to 10% return, which is perfectly decent. I think we've become somewhat we've come to expect that every year it's going to go up 20% kind of thing, but 6% is a perfectly good return. And I wanted to say one more thing about that. What was it? Now I can't remember. Anyway, within the market, one thing that's for sure is everybody loves cyclicals now. Cyclicals being companies that correlate to the economic cycle. Unlike the technology companies, which have a more structural story, and that was well proven during the pandemic, because they flourished despite the economic difficulties that everybody else was going through. So the net percent of fund managers, according to Bank of America's monthly survey, who say they're overweight these late cyclical type of sectors, banks, energy, and material, actually even higher than it was at the peak of the 2000s commodity supercycle. And they're also most overweight banks, commodities, and materials relative to their average weights of the previous 10 years. More than any other sector. And what's interesting is the second from the bottom, they're extremely underweight technology now. But it's also interesting to observe that the technology insiders who were buying technology shares all through last year did not stop buying, even though the market has gone down. They're still buying. In fact, the insider buying is at an all-time high. So I also find that just sort of interesting. Tesla, as you might have seen, reported a $5.5 billion profit on 2021 last year, up from $720 million in 2020. Speaking of electric vehicles, I'm coming toward the end, but I do find the copper NASDAQ ratio rather interesting. The thing about copper that's different from most other raw materials is it has a lot of applications, but the big driver is going to be electric vehicles. And the leader in that space is China. And people were becoming worried that because of the electricity blackouts in China last year, they were going to pull back on their environmental commitments, but actually they did not. And 2 days ago, Xi Jinping got together with the Politburo and he told all of them, look, we're going to continue to go for this greening of our economy, low carbon economy. And by 2025, they want to cut energy consumption per unit of GDP by 13.5%. And so what that means in part is building green railways and green highways and ports and sea routes and airports and electric vehicle battery charging, et cetera, which is all very positive for the renewable space, but also for copper. And just rounding off for those who can read Mandarin, this is the Zhengsheng Yubao, which is the Securities Daily, and that's actually owned by the People's Daily. It's owned by the Communist Party, but it's a government-owned newspaper that talks about the stock market. And anyway, the article here on the left is saying that Xi Jinping is telling us we must continue to go for environmentally friendly stuff, and on the right-hand side saying, yes, even though the stock market in the US has gone down, and that's affected us somewhat, there's a lot more easing policies coming, and that'll stabilize the economy and improve sentiment. And that's timely, and this is my last slide, because actually the mainland Chinese stock market is on the verge of going into a bear market, which the technical definition is down more than 20%, and that hasn't happened since 2018. So I think they're trying to prevent that from happening. Callum, I've done talking, so thanks for giving me the bandwidth, and I don't know if I should take the slides down now. Up to you.
Yeah, sure. Yeah, crikey, that's always a huge amount of information to digest. Thank you very much for that. So I've got tons of notes, and we've had a couple of questions come in. So actually, let me run through a couple of the questions. Anyone else on? Feel free to drop some questions in the chat box. Easy one to answer is that there will be a link of this video on the MBH channel on YouTube in the next few days, and therefore, so that's you'll be able to get the slides on that. So you mentioned L'Oreal right at the beginning. So somebody is asking whether you would care to share the other 12 companies that you're bullish on, or any of the other companies from that 12.
I mean, off the top of my head, I actually don't have the list, but I can furnish it to you, Callum.
Yeah, that would be very interesting. And that means JH that was asking that question, you just tap me up on LinkedIn, and we'll do that. So another question from JH was you mentioned, I think you were talking about meme stocks, and you kind of lump them in with NFTs and Bored Apes, and so you said that you saw that them being in the rear view mirror. How does that sort of tie in with crypto and your views on that?
I think that the first thing I want to say is that we are actually going to start covering cryptos over the course of the next few months. So whatever I say now might not necessarily be what the analyst ends up saying. But my own sense is that in a rising rate environment, those sorts of things probably will have less value. I mean, the classic way of valuing equities is the so-called discounted cash flow model, which is trying to ascertain the value of a company, and the discount will be the interest rate. And so, the higher the interest rate, the less valuable the company is, because its long-term cash flows, the ones that are further out, are less valuable. Now, it's not really a good analogy, maybe because there are no cash flows in NFTs. But maybe I just answered. Maybe I just said what I needed to say. Yeah.
Yeah. Do you see, so in terms of the those kind of meme stocks and Reddit, sort of that whole I guess retail populist approach, why do you see that going away? Why do you see that as a, do you think people are going to be returning more to fundamentals and values, or what drove that comment?
It's a very, very good question, because it doesn't necessarily have to go away. But when I just think of the extremely unusual circumstances that we've been living in, where people were staying at home a lot, and it was very cheap to borrow, and the whole tech sector, led by the superstars like Tesla, was on fire. I just feel that the planets have changed their alignment, and that story is not going to come back. And I think it's probably more of a gut feeling than something backed by fundamentals. But I think that kind of thing works in special circumstances, and those are probably not the circumstances that we're going to be in this year. I don't know about the years to come. But the meme phenomenon was, as you rightly point out, a momentum-driven phenomenon. I remember once in a while they would chase something that I actually kind of liked. Like, I remember they were chasing silver for a while. But there wasn't particularly, as you well know, any real fundamentals behind it. It was like, come on, boys, let's all get on board, and diamond hands, and hang in there. And I don't know, actually, how should I say, how that kind of thing can continue. Yeah.
Yeah, it's interesting. I have a obviously a vested interest in it, as somebody who, we have share investors, and we're always looking to how best to communicate the value of our company to new investors. And one of the things that struck me about crypto from a few years ago, and then the interest in meme stocks, was it was basically communicating to a younger audience that was used to receiving information in a different way. And so I wonder whether it goes away, or whether more companies need to find, because ultimately most companies, when they're trying to communicate their value, have done it in a very traditional, very dense, very difficult to understand way for the average or a new investor coming in. Yeah, I suspect it might still have a few legs.
Mm-hmm. Mm-hmm.
Yeah,
Yeah.
but who knows? All right, let's move on. So, I had a question. Your thoughts on uranium? Do you have thoughts on uranium?
Yeah, I have thoughts on uranium. I mean, number one, it's illiquid, so it can be quite easily. The share price, the prices can be moved quite easily, and so I do believe there's a certain kind of investor who has targeted it because they realize that. So the pro is that there's no way we'll meet our carbon emission targets without embracing some alternatives beyond solar and wind. We can't put the capacity in place quickly enough, and we can't generate enough electricity and distribute it, more importantly, on the existing grid in time. So I get the idea that that we need either to change these emission targets, which probably be a very hot potato for any politician to try to touch, or find some other ways to get there. And then, of course, uranium. Okay, I get that part, and I get how there are certain governments that really want to promote it, like France. The problem, though, is that even the smaller power plants, their economics are really bad. The nuclear power plants compared to solar and wind, they're just extremely expensive to build, and it's extremely expensive to manage the waste. So I get the concept. And if you had to force me to say up or down, I think I would say up. But actually, the economics are not quite right.
That's interesting. Yeah, there's definitely been a sway back towards nuclear, but yeah, I hadn't heard that the economics don't play out so well. Interesting. So a question from Michael Thomas. Thank you, Mark. Do you think there could be a major market correction in the next couple of years? And would there be a catalyst for something like this, aka Lehman Brothers?
Well, the short answer is there always is a major market correction. It's just the nature of markets. And they happen approximately every 10 years. And then approximately every year and a half, you get pullback around the magnitude of the one we've just experienced. So the $1 million question is that did we just do like one of those mini pullbacks that you do every year and a half, or are we on the verge of a big one? And then the answer will come through inflation and how permanent inflation is. But the other thing I would just say is that when I look back, I want to say when I look back at the corrections, the crises that I've witnessed in my career, there were people talking about some of them before they happened, but they could never get the timing right. So sometimes a lot of the time they're not things that anybody was talking about. Classic example would be COVID, right? I mean, nobody was talking about a global pandemic in late 2019. But I remember in the lead up to the global financial crisis, actually, there were people talking about subprime mortgages, and there were articles about how toxic these were and how it was all going to end in tears. But those articles, they started writing them in 2005, 2006, 2007. So you would have been right, but you would have missed a lot. And the Asian crisis, which I was also there for that. I remember people writing around 1995, 1996, the Asian miracle. Actually, it's not really true, and all they've done is they've borrowed a bunch of money in dollars, which is extremely dangerous because their currencies are all pegged, but they could easily break. And And so what I want to say is eventually that ended up being true, but you had to wait. It took a few years. So we can often kind of get a glimpse of what the problem is going to be, but knowing when it becomes a real bona fide crisis, I've never seen anybody do that. Yeah.
It's interesting. It reminds me of so the dot-com boom bubble. Everyone knew it was a bubble.
Yeah,
and we've been talking
99.
about it
Everybody
for years.
knew it was a bubble. Yeah.
But yeah, if you got it wrong, it was very expensive missing out. Well, what was interesting about the dot-com bubble actually is that the sort of the whole hype around dot-com, there were very few dot-com businesses on the market. Actually the top of the market in 2000 were a lot of companies like Microsoft, like Cisco, that were good, solid, profitable tech companies. And I guess what's potentially a little bit scary is that some of those companies took 20 years to recover their share prices. So if you were to draw an analogy of a Tesla or a Google or a Facebook or those guys, do you think that's an accurate or a potential accurate or different times?
Because Microsoft ended up having, financial fabulous renaissance, but it took 10 years to do. It managed to inch through the 2000s by being a software company, and it paid a decent dividend actually. So, but it was literally flat as a pancake throughout the 2000s, and then it became a cloud company, and a bunch of other things. So yeah, it's not impossible. I think it's not impossible. Never say never. Yeah.
It never ceases to amaze me how much profit those big companies are still making.
Yes.
It's companies that big aren't supposed to be still growing at 25% a year. It's quite staggering.
Yeah, I know.
A couple more questions to get through. So Walid Costandi says, with respect to dividend paying stocks, what sectors do you think are at risk of lower earnings and hence lower dividends in 2022?
Not banks. What else has high dividends? Utilities. Will utilities be impacted by higher energy prices? I'm just thinking aloud. Probably utilities I would identify as a vulnerable sector. Also because governments are under a lot of pressure to try to mitigate the pain of inflation. So there probably will be some kind of a peak at which utility companies won't be allowed to charge more. What else typically pays a high dividend? Telcos. I actually haven't looked at them in too long. I can't comment. What else pays a good dividend? Those are the ones I can think of. Real estate investment trusts. What would I say about them? Should be beneficiaries of COVID fading away. There basically now two kinds. There's the logistics kind and the data centers that have, of course, been huge COVID beneficiaries. But then there's the more traditional malls, office buildings, that kind of thing. Yeah, off the top of my head, I wouldn't think they would be that damaged. And in fact, probably more. But the U.S. REITs already went up far too much last year, so I wouldn't buy them. Anyway, I'm rambling on. Off the top of my head, I would think utilities are vulnerable, given the very high energy prices.
Okay, yeah, somewhat surprised me how REITs have done relatively well.
Fantastic! Actually, the reason is that REITs in America, a lot of them are residential, which we don't have elsewhere in the world. Yeah.
Okay. You touched on demographics and the older generation perhaps retiring a little bit earlier than we expected. But do you consider, so someone's asked, do you consider there to be an impact on the macroeconomy with a skew towards an aging working population?
Not in America. I've got a very bright, I think America's got a very bright future. despite all its problems, and we all know its problems. But the demographic profile of America looks very good through its Hispanic population largely, which is quite fertile, and the immigration, which is still, and I'm sure they're going to let a ton more immigrants in. They really, really need to try to rectify the labor shortage. So not in America. Really, every country is different. We in Singapore, we have a demographic problem. China has a demographic problem. Goes without saying. So does Japan and and most countries in Europe. India does not. India working age population won't peak until around 2060. Every country is different.
Okay. I'll skip over the crypto questions until your analysts get to work. So question from Chris Sleeman. With regards to the labour market and immigration, do you think less people will work abroad post-pandemic? We have seen a huge decrease in Europeans working in the UK, but Brexit and COVID was the perfect storm.
Well, Callum, you and I live in Singapore. What do you think? I read these articles in the paper about everybody's going home, but I don't see it. My condo's full. There's no places available. And I see all sorts of Caucasians on the bus and in the subway. I think people will go places if they can. The main question is, will they be able to? And so my biggest concern actually is the governments have become so, a lot of governments have become so, what's the word for it? They've so invested in COVID that it's difficult for them to undo that, like without people saying, well, wait a second, that means you really messed up before. Like you and I were chatting before we went live about New Zealand. They're one of the last of the Mohicans. I mean, imagine if they just said, oh, opening up, it's okay. Then people would be like, what were the last 12 months for? What did you do that for? So anyway, I was rambling. But what do you think?
No, it's interesting. I mean, we have seen a lot of people. So my wife works in an international school, and a lot of international families have returned primarily to be closer to family. I think after the restrictions of the last 2 years, I think my personal view is that they'll spend a year close to family and realize exactly why they left their home countries in the first place. And I think we'll see a big input. But equally, a lot of Singaporeans that were living and working abroad have come back to Singapore because again, wanted to be near a family during these times. So I think in answer to Chris's question, Brexit is a fairly unique issue for the UK, but generally I think as soon as people can travel, the ones that will want to, we'll do it again where possible. Okay, two very quick ones to finish off. First one from SJ. What are your thoughts on commercial non-debt based financing innovations such as inventory and transit monetization as offered by SupplyMe Capital and Tradeflow Capital Management?
I am sorry.
You know anything about?
No, and I remember my very first job in the morning meeting, I said, in answer to a question, I said, I don't know. And my boss came up after and he scolded me. He said, never say you don't know. We always have to know. That was a stockbroking company, but I don't know. I'm sorry. No, I won't try to make something up. No.
All right. And our final question is from Dan Taylor. What's your personal thoughts on the UK interest rates over the next 3 years or so? Do you have any personal thoughts on UK interest rates?
I really, I mean, clearly the BOE is one of the more hawkish central banks now, and I must confess that we don't spend enough time looking at the economy there for me to comment. I better not. I mean, the similar story to the U.S. Very chronic labor shortage, and so I think that the answer will be entirely contingent on COVID. that's all I can think about.
Fair enough. Well, COVID doesn't exist there from today. That's all restrictions have been lifted. So yeah, we shall see. Mark, it's been an absolute pleasure as always.
Pleasure for
I've got
me.
pages of notes. For those that are asking, the video will be up on YouTube in a couple of days, so you can watch it and go back to the relevant areas. If Mark very kindly sends me his list of companies that are doing digitization well, just reach out to me on LinkedIn and I'll be happy to share those with you. But otherwise, Mark, thank you very much indeed.
Thank you,
Let's
Callum.
not leave it 9 months, because I'm sure there'll be lots of exciting things going on this year. I think, as I mentioned at the beginning, at MBH, we've got 27 companies now in 5 countries around the world, and across 8 different industries, and across the board we're seeing huge demand. And actually, a lot of the supply chain issues seem to have gone away insofar as availability is there, but pricing is definitely quite flexible, to put it that way. We have definitely seen challenges with either sickness or just having to quarantine, but hopefully that will be sort of moving away over the next couple of months. But yeah, overall we're very bullish on 2022. So yeah, it's going to be an exciting year. So thanks again, everyone. Thank you for tuning in, and yeah, we'll see you all soon. Thanks. Bye.
Find out more today at mbhcorporation.com.